it would take 2 weeks to get that thing back. The realtors would be going crazy about, did you get the credit back? Did you get the credit back? That was a constant phone call, and very annoying. But then we upgraded because the credit companies figured out a way to put a printer in our office. We could print the credit reports after we sent them to them. After we sent the app to them, they'd download all that stuff into a printer, and all of a sudden that printer would start shooting off credit reports, which made it a lot easier because it saved a few days of transportation between the credit company and back to the office. And then when FICO scores started coming in the early 90s, and everything was becoming digitized, then all of a sudden we were able to access credit a lot quicker online like we do now and get more accurate information. So it's changed quite a bit, and how that affects us, now that lenders and Fannie Mae will accept digital signings on applications and certain disclosures, we're okay with it. It makes life a lot easier. We don't have to, we can function with keeping the door locked because people are calling in.
That's so interesting.
To walk in.
I've always wondered how DocuSign, the legality of it, it's like official, right? When someone does DocuSign?
Very official.
Okay.
But right now they still won't let you do DocuSign on loan documents, the final documents.
Okay.
They have to be wet signed in front of a notary.
Okay, yeah. That's interesting. I was talking to Johnny about notary stuff because over the summer I wanted to get I have this internship lined up at with a family friend, and she was telling me that I should take a class to learn to be a notary, to help people sign and stuff, and I wanted to learn more about that.
There's two classes you're going to take. You're going to take the notary class to get the license, right?
Yeah.
Then you're going to take the signing class. But what you want to do is you don't want to just take the signing class and just go out there and put yourself out there and say, I can sign loan docs now. You gotta work with somebody at least a half a dozen times to see difference in loan docs and follow the signing with them so that you know what you're looking at. Because if you just jump right into this, even into the class, you're going to get lost. And then what will happen is you might miss a thing, or it didn't get notarized properly, and it'll delay the funding of the loan because they'll have to track you down, track the customer down again, re-sign, re-notarize. So you want to spend some time with somebody that does it, and even if you had to pay them to be with them while they're signing some loan docs for somebody, do it.
Okay.
If you can get away without that, great. But you want that experience so that you can see how they operate. When my gal went to the notary class, and actually the signing class, not the notary class, but the signing class, they told her specifically, don't explain any of the loan docs, don't do anything like that at all. And for somebody that's outside, it's okay. But when she's in my office signing my loan docs, I want her to be able to understand what that document is so that she can paraphrase quickly what it is. If she says, this is the note, I want her to be able to see and show the borrower, here's the amount of money you're borrowing, here's your payments, this is when they're due. Here's your interest rate, that's it. I don't want to have to go through every little paragraph. I've got to be able to talk about the salient points of the note and the trust deed. You can paraphrase the trust deed pretty easily because you've got 4 pages of documents there that basically say, if you don't do 5 things, we can take the property back. And what those 5 things are is obviously make the payments, right? In a timely manner. Pay the taxes, keep it insured, right? Maintain it. And if it's an HOA, pay the HOA dues and follow the guidelines of the HOA. Otherwise, if they find out that none of that stuff is going on, or even one of those items is not happening, the lender can force the issue. Say you don't pay your HOA dues. HOA files notice of default, the lender will go in there and cure it, and then they'll cure it and they'll make a payment structure with you, but if you don't follow it, they'll file the NOD, the notice of default. and they'll start working to take the property back because you haven't followed the HOA guidelines, which is make the payment.
Okay.
So you don't want to get any, as a signer, you don't want to get too deep into that. All right. But you want to make sure that they understand, look, these are the things you have to do. Everything else, when you start going through all these papers that are here on my desk that hopefully you can't see, these, if it says, look, this is the tax form, what you're signing here allows us to get a copy of your tax transcripts. That's all you need to say. You don't need to go through every paragraph because you'll be there for 4 hours. And you want these signings to last about an hour. So, but
I'll
if you
definitely
go
keep
with
that in mind.
somebody, try and go with somebody and just watch what they do as many times as you can. And then you can say, look, I've got experience, and you can start selling your services.
Hmm. I appreciate that advice. I'll definitely keep that in mind.
Because you can make some decent money at it.
Yeah, yeah, I've had people tell me that.
Well, you know, up in Victorville, I was up there a few years ago, and down here they were getting $175 a whack to notarize at the time. Up there they were getting $75 a whack to notarize. Now we're at 200 to notarize stuff. So I don't know what it is in Orange County, but at $200, if you're good at this and you're knocking out 2 or 3 a day, that's pretty good money.
Wow. I actually live really I live nearby Victorville. I live in Palmdale.
Oh,
When
do
I'm
you?
not in
Okay.
when I'm not in Irvine.
Yeah.
Yeah. What time is it right now? It's 6:10.
It's 6:10.
Should
So
we?
I think we can go ahead and start if you want to go ahead and do that, Sam.
Okay.
I don't know, you can go ahead and introduce yourself a little bit, or
So John's already told you my name, but I'll give you just a little brief background on how I got here. I was a box boy at Safeway from when I was 15 years old until I was about 18, when they would allow me to become a clerk. And I moved from San Diego to LA, actually in the San Gabriel Valley, and I was working at the San Gabriel store. And they started moving me slowly up the ladder to be a department head, and then they promoted me to a third man night manager. And they promoted me to third man night manager in the ghetto. And I was not real comfortable with it because I was driving a Cadillac at the time, and it was a little parking the car in the parking lot. And one night it proved right because I had to remove somebody from the store. And after the store closed, I went and parked my car right in front of the store, and I heard this crash. And I went and looked, and I saw my car was still whole, but I went outside, and somebody had heaved a chunk of concrete about this big against the side of my Cadillac and hit the glass. Well, being a Cadillac, the glass was pretty thick, and it really didn't do any damage. It was really just bounced right off. But I think that was the start of my discomfort of being any kind of management at Safeway, because I thought, you know what, there's got to be a better way to make a living. And I left that store, went to another store, and eventually I left on a workman's comp injury. And I wasn't happy about that. I got my real estate license in 1976, actually 75. I started selling in 76. And sold for 5 years through the recession in 1981. Took a break for a couple of years. And when I was selling real estate, I was watching the lending business. And I thought that seemed pretty interesting. And it just so happened that I was going out with a gal who worked for what used to be San Diego Federal down here in San Diego County. And it was a pretty large operation. And she was an underwriter. And she started telling me what these guys were making as originating loans. And it was considerably more than what I was making, even in my best year as a realtor. So, and I was selling apartment buildings. I never sold houses at all. So I was back in LA. She was in San Diego. I was visiting her on the weekends. And finally one day I said, you know, I got to get back to San Diego. I don't want to live in LA anymore. My immediate family was down here, and I thought it'd just be a better place to live. I'm tired of having to leave LA on the weekends. And I said, if you hear of anything, let me know. So I told one of my best friends the same thing, and I'd stay with him on the weekends when I came down. And it just so happened that he had moved into this condo in Mission Valley right next to the owner of one of the biggest strip clubs in town. And I was bartending at night at my cousin's restaurant on Sunset Boulevard. And I told Paul, get me a job bartending at the strip club. I just need something to fill me in, get me down back to San Diego until I can get something that I really want permanently. So he actually got me an interview, and the interview was 2 hours at the bar in the strip club. And after about an hour and a half, the manager came over to me and said, here's $50, get out of here. And that was the end of my bartending career at the strip club. It was hard to concentrate. So Stephanie, the gal that worked at Great American or San Diego Federal at the time, called me one day and she said, hey, there's an interview for Home Savings of America. And I came down in January of 1983, interviewed twice, and they hired somebody else. But I stayed in touch with the manager of the office and called me in July of 80, and they said, okay, we have an opening for you. So I went down, interviewed again, and I said, all right, I'll let you know in a few days. I'll just give me a few days to think about this. So I did, called them up and I said, I'm taking the job. I'll see you in 30 days. Packed up and from LA and never looked back. I had a great career with Home Savings. I was #1 in the nation in production, and that was closing over 480 loans a year, which is a lot of loans. I was #1 in San Diego County in production for 7 years running until I walked out the door. And then I got hired by American Savings, and 2 years later we were bought out by Washington Mutual. I stayed with that whole group for another 3 years. And then in 2000, I started on my own and opened up this brokerage. And then a couple of years ago, I became a banker so that I actually fund my own loans now with a line of credit. I'm just this minuscule little thing, a banking operation, in comparison to some of the larger ones that you've heard of, like Caliber, Plaza, Sierra Pacific. Everybody operates the same way. They operate with other people's money to fund these loans until they're sold into the secondary market. And then they get their money back and they relend it. So that's how I got to where I am in this little operation over here. And as I was telling some of the people earlier, I had other people in here originating, and I've trained scores of people over the years to do this. But I really have a really good spot right now where it's myself and my assistant and the processor, and we just do loans. That's all we do, and it's a great deal. What I wanted to talk to you guys about tonight, to get onto this, is what we look at when we're doing loans. Because it's important to you to understand, whether you ever got into the real estate industry or not, it's important for you guys to understand what a lender is looking at. And basically, whether it's commercial or residential, it doesn't make any difference. So the things that I'm going to point out to you tonight are the key items that are considered in a loan transaction. So you can ask me questions as we go along, but what I'm going to do is I'm going to start using this whiteboard here that John was so great to provide. It's kind of a temporary hookup, as you can see, because I duct taped the whole thing to my back wall. So these 4 items that we're looking at are collateral, ability to repay, willingness to repay, can you all see this?
Yeah, it's not like it. Yeah, I can see it. I can read it from
You
here.
can see it. Yeah.
And equity. 4 key items to making a loan. So when we were at Home Savings, we were basically an equity lender. So we didn't, when I started there, we did not do FHA loans. We did not do VA loans. We only did conventional loans, and we only did adjustable rates. Everybody that came in the door had to come up with at least 10% down so that we knew they had a stake in the property. Because the larger the stake, the less likelihood that we're going to end up with the property in the long run. Here's what we're looking at nowadays, more so than ever before. Collateral is what's securing our loan. So if you bought a house, what's the average price house in Orange County?
Probably like 750,000.
Okay, 750. And that would be maybe a 4-bedroom, 2.5 bath, 2-story, 2 to 3 car garage, right?
Yep.
Okay. And chances are it's going to conform to every other house on the block in one way or another. There'll be little differences there, how it looks from the street, but basically it's not going to stick out like a sore thumb. So the most important thing collateral is that it looks like everything else, or at least it's similar to everything else in the neighborhood. So if you went into Santa Ana, you know you're looking in Santa Ana at 60-year-old homes in a given area. If you go into Irvine, parts of Irvine or other parts of Orange County, you're going to be looking at 50-year-old homes or newer. They conform, right? The example that I use a lot of times is the one that doesn't conform, the one that a lender won't make a loan on, and that is very simple. If you're not familiar with San Diego at all, there's this place called Dictionary Hill, and it's got a great view. About 35 years ago, some guy built an octagon house on the hill, and it was all wood shingles. So if you can imagine this octagon house, and it looked like a big ball sitting on this hillside, made out of wood shingles with its windows cut in by the octagon. That was the only thing that was vertical where the windows were. No lender wants to own on that house, because if something happens and the borrower comes back and they can't make their payments, the lender's stuck with this house that nobody else wants. It doesn't fit into the neighborhood at all. They have to go to a different type of lender and pay a higher interest rate and put more money into the deal before they're gonna get a loan. So let's say that house was sitting in Orange County and they said, okay, yeah, it's 3,000 square feet. It's worth $750,000. And that's the only conforming part of the whole thing. It's still this octagon shape. Whereas you guys might get, you know, normal person might put 20% down. This isn't going to happen on an octagon shaped house or something weird. They're going to have to put in 40 to 50% down. And if the rate for the normal house is, let's just say 4%, chances are these guys are going to pay 7%. And that's the price they're going to pay for owning something that's totally out of the norm of the neighborhood. The collateral is important. The condition of the collateral is equally important. You know, up until the meltdown in 2007, a lot of things they let them slide on the condition of the properties. And it used to be that FHA and VA loans were the ones that were toughest loans to get because they were looking for condition. But after the meltdown, the standards for the condition became equal amongst all of the different types of loans, whether they were government or conventional. And it didn't make any difference about down payment. We still now have to see that there's no broken glass, there's the water heaters are strapped, there's the detectors for smoke and carbon monoxide, there's floor coverings, there's no peeling paint. All of these different things have to be accounted for when the appraiser goes out there. so that the condition is livable. If it's not livable, the seller has the opportunity to make it livable, or they can sell it cheap to some investor and let this investor make it livable. But they have to be habitable without those conditions. So if you've got good collateral, you're more than likely to be able to get away with less equity from the buyer. So the ability to repay is, how do you earn income?
You have a job.
Yeah, the job is cool. But it's not just having the job. It's having consistency in your employment. So let me give you an example. Last year, who's the person with the beach in the background?
My name's
Where
Rod.
are you?
Oh, I'm on my bed.
Is that a window behind you?
Oh,
You can put an image behind you.
oh yeah. I just put an image behind me.
It's a virtual thing they can add on this app.
Oh, really?
Yeah,
Yeah.
that's
No,
why
no.
I have our logo behind me.
Okay.
It's 'cause my place
So
is
anyway,
up. Yeah.
Back to the Future. A guy and his wife and their kids moved down from Nevada. He had been in business for himself, and they had some kind of a business together. He was a contractor, and they'd had a secondary business where they were selling on a pyramid marketing thing, similar to Amway, and they were doing pretty well. But they decided they wanted to move to San Diego and into Bonita in particular because his parents lived here, and they wanted the family to be close. The wife had been in business for herself. She was house cleaning, and she also had a degree, but she was making more money house cleaning than she was with the degree. She lived in Sacramento. About, I don't know, 3-4 years ago, they got married. She moved to Nevada, and then, like I said, last year they moved to California together, brought all the kids down, went out and bought a house. And we had traced all of his employment. We traced her employment, and we had it into underwriting. And the underwriters kicked it out because his employment was inconsistent. And I could have made a good case for him, but here's what happened. 6 months that he was in San Diego working on a paycheck job, so we had verifiable income, he had taken 6 weeks off. He really didn't have 6 months worth of income anymore. He had 4.5 months worth of income. The consistency of his employment was not good enough to get him a loan. So they ended up having to rent a place simply because he needed at least a year on the job. And prior to that, I'd had another one just the same way. And the guy was an underwater welder for Navy defense contracting, right? He was working on the East Coast, and believe it or not, the guy had an accident on a skateboard and had a brain injury. Wasn't wearing a helmet, and he took about 3 years to recuperate from the injury. And when he went back east to start at the job again, he found he couldn't weld underwater anymore. He could only weld above water. So welders are in demand, especially with his skill set for welding on Defense Department projects. And he moved from place to place. So we trailed his employment, and he was never without a job, but his employment was inconsistent. He never stayed more than 2 or 3 months at one job, even though he was in the same field. So what happened was, we took his app. He'd been at this one job for 3 months. And I thought, okay, this is a little dicey, but what we're going to do is we'll just trail all of this. Well, we went to verify his employment, and they said he doesn't work here anymore. Well, the guy showed up with his wife in the office one day to bring us some information. And I said to him, I said, hey, what's going on with your employment? They're not verifying it for us. Oh, I quit that job 2 weeks ago. I said, well, why? He said, well, I got I don't know, it was like a 50 cent an hour raise, whatever it was minimal. And I said, well, I think you just screwed up your loan, because we need your consistency here. We can't have you job jumping. They denied the loan. It was just that simple, because 3 months here, 2.5 months here, 3 months there. There's no consistency to the employment. And it's like working for a union. If you're in the electrical union and they send you from job to job to job, work with that. Even if one job is only 3 months, but the catch is, and the catch was for this guy also, if he had moved job to job to job, but had done it for 2 years and reported consistent income, we would have taken it. Because now we know the guy can go from place to place. He's always employed. He's making consistent money, and it's going to work. So he's got stability in employment because of his skill set. But if you're working for somebody else, and in this particular case, like I explained, it's job to job to job. I move for 50 cents an hour more. It doesn't work, especially if you've only got 6-8 months back on the job. 2 years, we would have taken the deal in. So the consistency is critical to this. It's not just what you're making at the moment. So if you go self-employment, they'll look at 2 years of tax returns for self-employment. And that's what we're going to base it on. The trick to this is, if your income is stable, great. If your income is rising from 18 to 19, we're going to average it. But if 18 was at 100,000 net and 19 was at 75, we're not going to average it down. We're going to take the 75. Now that's what we're qualifying you with. So now you have to qualify based on 75,000 instead of 100,000. Makes a difference. Let me give you a good example. I just closed a loan for my niece's boyfriend. He's self-employed. He's considered essential to the Department of Defense. And what his job is being a consultant for fuel delivery to bases around the world for the Department of Defense, not just the Navy, but the Marine bases, Army bases, you name it. He's all over the place. Mostly he's in the Mediterranean and South Pacific, East and West coasts of the United States. And so he was talking to me about 1.5 years ago, and he said, I want to buy a house up here in the hill where I live, right? And I said, you know, you're looking at about $1.2 million to buy this house. So this is what you need to make. And he said, okay, you know, I'm making that. I said, what do you have for a down payment? You can use a VA loan, but you still have to have some money in the pot here, because we're not going to make a VA loan of 100% on $1.2 million. So about 6-8 weeks ago, he called me up and he said, the neighbors to where they live are selling this house, $625,000. We're going to use the VA loan. And he wanted to put money down. And I said, great. So he started sending me his tax returns. And his tax returns did not show enough income in 17 and 18 to qualify. Because it wasn't just net income. What he had done, what his tax person had done, was he's got a corporation tax return and a personal return. And the accountant had written off some stuff that could have been amortized over a few years. He took it all in one lump and dropped his income so low that he couldn't qualify. He had to file his 19 returns and pay the tax so that I could use the 19 return and average up. So we got rid of 17. We used 18 and 19 and averaged up, and then he could qualify. He was unhappy because in his mind, he's thinking, you know, I'm making $250,000 a year. Why can't I afford a $3,000 a month payment? And several times I had to explain to him, your net income, your guy is writing off too much, and he's writing it off the wrong way. and you have less income to report. You need more money. It's just that simple, and that's what we're looking at. So if somebody's self-employed, we're happy to take them, but they've got to have a couple years of self-employment, and the income has to trend upward, stay stable. And that's what we're going to base our qualifying on. That is ability to repay. Those are some of the highlights of it. So we're looking at consistency of income. We're looking at job stability. Could we take one of you guys after you've been in a job for a year? Who was going to Amazon?
Me, yes.
Okay. Well, what's your name?
Lam.
Lamb.
Nice to meet
Okay.
you too.
So would we take Lamb after only being a year on Amazon? If he started his employment right after he got out of college, what we'd ask for is a copy of his degree. Now we know where he spent the last 4 years. He gets this job with Amazon and he's making X amount of dollars, and it's only for a year. But we know that what he was doing before. So we know there's a consistency of work. It just wasn't Amazon. We would take his application and run with it.
Oh.
So there's varying factors in this. So if you were in my job and Lamb came to you and said, look, I want to buy this house, it's not just black and white. We have to analyze the whole thing, and we've got to ask Lamb a bunch of questions to get down to the bottom of this so we can figure out if the willingness or the ability to repay is going to fit in the box that Fannie Mae has for it. And it's just that simple. And it doesn't happen that way unless we start digging deep in Lamb's past. I don't care what he does at home at night. I just care about finding out his employment history and what he's done so that we can make a case for him to get a loan. Make sense?
Yes.
Okay.
I actually have a question.
Yes.
So let's say in the next 2 years, I will try to work at minimum wage for Amazon.
Right.
And then after that, I will get into like maybe an accounting firms and have a higher salaries. When you make a loans, do you make that? Is that will that increase my chance of getting a good loans?
There's a couple parts to that question. Okay.
Yes.
So let's clarify them for you. If you've been at Amazon making minimum wage, and now you've got your degree in accounting, and
Yes.
some CPA firm hires you in Orange County or anywhere else, I don't care where it is,
Yes.
and they're hiring you at 3 times what you're making at Amazon.
Yes.
Just after you've got a couple of paychecks, we're going to make you the loan.
Oh. And
What'd you study in
like how
college?
many pages?
Well, I studied accounting. And what'd you do in the meantime? Well, I worked 2 years at Amazon, saving my money for the down payment.
Yeah.
I don't really care where you get the down from. That's just an example.
Yeah. I'm
Right.
looking to do that too. Yeah.
But I got 2 years at Amazon. I studied at college. I got my degree, and now I'm plopped into this job with this great CPA firm paying me X amount of dollars. Great.
Yeah.
Great.
Yes.
I'll take your loan.
Thank Please give me your email or something so I can contact you after 3 years.
Anybody else have any questions on ability to repay?
Yeah, so I just have a question in general. So like
Sure.
say like some 2007 thing happens and like I guess people can't repay their loans. Like I guess how would you approach that type of situation? And like how would you prepare for that? Even though like it looks good on paper, but like some like unexpected like circumstances happen or something.
If you can document the circumstances, remember one thing. People lie to us all the time. Seriously. I mean, it's hilarious, the stuff that they can come up with, okay? When people tell us stories like you cannot imagine. So to get back to answer your question, I'm going to tell you a story after I answer your question, okay? Let's say something catastrophic happens. You're diagnosed with cancer, you're off work for 2 years until you're healed again, right? In the meantime, you lost your house. Could you get a loan? Yes. But you have to be able to, you have to wait for at least 2 years from the date of the foreclosure, if that's how you lost it, or the short sale, and have reestablished credit in that 2-year period to get a loan to buy a house. Does that help? Does that answer it?
Yeah. Okay. So it's like you have to just give it a little bit of time, kind of, and they have to just show that they're credible in like that 2-year time period, even when losing their job and stuff. Okay.
Let me tell you what happened. I'm going to tell you 2 stories. First one is, I know it's true because I actually saw the reports from the lawyers and the doctors. There was a psychiatrist, worked up in North County. He went to one of my friends to get a loan to refinance a house in La Jolla. He paid cash for the house. He paid like $950,000 for the house. And he decided to remodel the house. And it was going to take quite a bit of money to do it. He'd already poured a lot of cash into it. But I went out and I looked at the house. And I'm going like, yeah, you're going to need some serious money here. And I said, okay, here's the bill. We'll lend you $400. And at the time, the max loan on conforming was $417. I said, we'll lend you $417,000. But in the back of my mind, I'm thinking he's going to need even more than this because the contractor was just taking advantage of him. And the reason he couldn't get a loan at Wells Fargo was very simple. He was on his way somewhere, driving a Porsche, making a left-hand turn with a left arrow on some street up in North County. Some guy had a diabetic blackout, ran the red light, broadsided him. He was so torn up, they never knew while they were trying to extricate him from the car. He was in the hospital, induced coma for 6 weeks. When they finally patched him all up, he went into a rehab facility for another 6 weeks. He was able to go home with somebody to help him. When he was finally able to get his bearings, he had these 2 properties down in the desert near El Centro. And he hadn't been able to make payments on them because of him being in the hospital. So you got to figure now we're up to 4 months, right? The lenders foreclosed on the properties. They wouldn't work out anything with them. They just did 2 foreclosures. So when he went to Wells turned him down, even with a solid documented story of what happened to him. So my friend sent him to me. I took him to a bank, would overlook that, but the rate was higher and the fees were higher. But after the foreclosures off of his record, I took him to an A-paper lender and I made $1 million loan at the same house with a very low interest rate. We got him down from in the 7s to 3.75. Conversely, this is one of the best stories ever. A realtor brought this gal to me to buy a house. This is like 1993, right? And I was still at home savings, and they were putting money down and 10% down, and the income was there, the job stability was there. But the weirdest thing showed up on her credit report, and it was a collection account for like $1,500. So I called her up and I said, hey, there's a collection account showing on your credit report for $1,500 and it's owed to so-and-so. I said, is that yours? And she was aghast on the telephone, right? And she says, that was my ex-husband's. He was supposed to pay that half of the rent to the landlord at the place we lived at, and he never did it. And I said, does the landlord agree with what you're saying? And she said, yes. Okay, get me a letter from the landlord with his name, his address, his phone number, that he says it's okay, we'll waive on this then. So I didn't hear anything for a few days, and the realtor was calling me up saying, hey, what's going on? And I told her, I said, hey, we need this letter from the landlord to clear this condition. We haven't gotten it yet.
Jeez.
Finally, the letter shows up in my office. I read the letter. I called her up and said, hey, how do I get a hold of this guy? There's no phone number on it. There's no address. She said, well, I don't know his address. I said, well, then tell me how to get there. You obviously went there and got this, so tell me how to get there. So she gives me this roundabout thing, and
Yeah. No.
later on, I got a phone call out of the blue from the landlord, the former landlord of all people. And I said, man, I said, I'm so glad you called. I said, I've been trying to figure out how to get a hold of you to talk to you about this. And he said, what letter? Oh, I got off the letter subject real quick.
Yeah, like that's awkward.
Yeah, I'm right in the middle of this now, right? And so I said, listen, let me call you back. So I called her up at work and I said, hey, I said, I got a little problem here. I said, just by chance, the landlord called me. And when I mentioned letter, he said he didn't know anything about a letter. So can you tell me what's going on? She barely speaks out. Basically, she wouldn't admit that she had written the letter and signed his name, which is what she'd done. And I said, look, I suggest that you pay the landlord immediately. I said, the reason I suggest this is because Home Savings is a federally chartered institution. And if I bring this to my boss, I guarantee you that the FBI will be coming and knocking on your door because this is loan fraud. You have to pay this man. So what does she do?
Oh my gosh.
She puts the boyfriend on the phone, the fiance, right? Now she's like 8-9 months pregnant with this guy's baby. And they're getting married and they're going to move into the new house and start life together and everything's grand. And the guy comes on the phone and he starts reading me the riot act. We're not paying that. It's a matter of principle. I said, you have gone way beyond principles. Your girlfriend wrote a letter and signed somebody else's name to it and turned it into me to get a loan. I said, it's quite simple. Pay the man or I'm going to take this to my boss. And they're going to be talking to you about loan fraud. You have two choices. Tell me what you're going to do. So he calls me back later on and he says, we're meeting in your office. So the landlord and this guy are at my desk. And they start talking about this thing. And I said, listen, take this away from my desk and go into the conference room. I don't want to hear this. So they did. They came back. They said, okay, we've got it all settled, but I'm $1 short. And so I ended up putting the $1 into the deal myself and we closed the loan. The story gets better. About, I don't know, 4 years later, 5 years later, guy comes back to me for another loan. He's got all these lates. Now they're married. The kid's like 5-6 years old by now, right? And I look at his credit report and I'm going like, hey, what's going on here? Why are these lates? Oh, I switched banks, blah, blah, blah. The credit union didn't do my automatic payments. I said, okay, fine. Give me the documentation. Same realtor calling up. Hey, what's going on? Why is this closed? Because he's getting me documentation. Finally, when they knew I wasn't going to close the deal, he calls me up one day and he says, I got to tell you, I didn't tell you the whole truth. Those were really my problems, not the bank's.
Say.
Now I got to be twice lying to me, right? So we closed his loan. We worked it out. We closed his loan. So about 7-8 years ago, he came back to me, buying another house out in Hamul, which is out in the sticks in San Diego County. And it's more expensive. And he says, I want to buy this house. I've got X amount of dollars. I said, okay, let's do it. Pull his credit report again, call him up and said, hey, there's some things on here. Are they yours? What's going on? No, they're not mine. I don't know how those got on there. And I'm thinking to myself, wait a minute, I remember this same story. Sure enough, 2 weeks later, same realtor, calling me up saying, hey, what's going on? We have credit issues again. And he's lied to me again. Finally, the guy calls me up and says, well, I got to tell you the truth. I've had this happen in the past, but, blah, blah, blah. So we made him the loan, right? Here's the catch. Here's the final thing. I came into the office one morning, and I was getting the newspaper every day. And there's a picture of the supervisors for the Sweetwater High School District. And front and center on the very front page is my customer being indicted for taking bribes.
Oh.
Funny.
So I tell you that buyers don't tell the truth.
This guy.
That's easy.
I'm telling you guys, this is the kind of stuff we have to watch for. And this is when we start asking questions. We have to watch what people are doing because they're starting to get nervous at our desk. It's crazy you're watching their body and their facial reactions. I've had them just grab onto my desk and hold on tight like they're on a roller coaster ride. And because they're so nervous about what I'm asking them. It's crazy. Let's move on. Willingness to repay. It's all about credit. Are you willing to repay your debts? Are under the terms that you asked for to begin with? The biggest issue, and I'm going to tell you this, when you're parents, when you guys become parents, never co-sign for your kids for anything, okay? And if your parents say no to you right now because you want to go out and buy that new Honda Civic SI for $35,000, let me tell you,
No.
to ever do this. Never. Are we all in agreement on this? Never.
Okay.
I almost did that. Oh,
Because
God.
as soon as you sign and your kid doesn't pay, it's on your credit report too. And you're wondering now, it's like, okay, what happens here? What happens? Well, what happens is really simple. The parent's credit score goes down with the kids. And it'll take a bigger tumble than the kids because the kid already has a low score. That's why he's asking the parents to co-sign. The kid doesn't care.
Oh, God.
Don't co-sign for anybody. When my niece needed a new car, the first car I bought her, right? She wrecked it. Plain and simple. I said, okay. She found another car, reasonably priced. I said, I'm going to help you out with this just a little bit. You're going to take the rest of your money and you're going to pay for it all. She wrecked that one. She got some money out of it from the insurance company. And I said, okay. She wanted a brand new car. I said, all right, but I'm not co-signing for you. I don't care what happens. I'm not co-signing for you. I said, what I will do is I will make a down payment sufficient to give you the payment level that you want, plus your cash. This is her picture. I'll show you. I'm going to swing this around. This is Misty right here. I don't know if you can see it or not. So anyway, I went down to the Nissan dealer in Pacific Beach. I said, okay, sell me that Sentra. This is the payment that I need. And I made the deal with them for exactly what she said she could afford, right? And I gave her a little more money for a down payment. She's signing the note. I'm not signing. And they had a little problem with that. And I was like, no, you either take the deal or you don't take the deal. I mean, we're putting a lot of money down. She can for this car. So they took the deal finally. I won't sign. I just won't do it. And in the end, she totaled that car anyway. So she wrecked 4 of them. So the last one, when she got the money for the insurance company from the car, she went out, she found a used Toyota, paid $5,000 cash for it. It's like, okay, that's good. I'm glad you got that car. That's great. I didn't have to put any more money out because I said, you are on your own. That's all there is to it. But I'm telling you, do not co-sign for anybody. Okay, back to willingness to repay. Here's the thing. When I started in the industry, we would look at a credit report, and the two biggest offenses anybody could have, and consistently, even if they had perfect credit, were Sears and JCPenney. And so, don't be eating in front of me.
Who's eating?
No.
Yeah, who's eating?
So, anyway, Sears and JCPenney. But we always knew that Sears and JCPenney had the worst credit reporting accuracy in the industry. So if somebody wrote us a letter and said, look, I was never late with Sears, chances are we would buy it, because if that was the only thing wrong with their credit, it would, and the rest of their credit was good, we'd go along with it. Then all of a sudden, scoring came in. And you know, you see it advertised on TV now with all these different companies that are trying to improve FICO scores and give you FICO scores. Scoring came in, like I was saying earlier, in the early 90s, about 93, 94, and it changed the world for borrowers completely. Because what was happening was the secondary market was requiring some standard of underwriting, and scoring was able to do that. And as much as people don't like scores or are trying to improve their scores, a lot of it was based on pure fact. To give you an example, in 1996, they did a study. FICO did a study on foreclosures, because in 91, 92, 93, there was a slump in the market, and a lot of people lost their properties. So they started analyzing the credit reports of those people that lost their properties. And they started assigning them, they started digitizing what was going on. And they developed these scoring algorithms. And what they found was very simple. If you went below a 620 score, the chances of a foreclosure increased exponentially. And if you were at 450, which was the lowest score, the chance of having that property back within the first 90 days was 100%. If your score was in the 500s, you'd probably end up with it in a year. And it was proven time and again. It wasn't just like, oh, just this one little couple over here, they lost their job. This was across the country they did this. Because the analytics were becoming more and more available to be able to get this kind of a algorithm built. So now the minimum score is 620. So if you said, okay, I want an FHA loan with 3.5% down, minimum score is 620. A few years ago, and not a few years ago, like 10 years ago or so, you could get an FHA loan with a lower score than that, in the low 500s. But you were guaranteed a foreclosure. Now, if you have a score that's less than 620, down to 580, they'll still make you an FHA loan, but now you have to come in with cash. You can't just do it with 3.5% down. You've got to come in with 10% down. And you're going to pay a higher rate than somebody with a 620 score or above. So the willingness to repay is critical. I had a manager once who could go through a credit report and a file in 60 seconds. And you could look through the whole thing. And what I learned from him watching him do this one time was, he said, there was a questionable loan. And I told my boss, I said, hey, take this to the regional. If you think it's okay, take it to the regional, let him sign it for you. And so John came down one day and he looked at the file and he literally flipped through the pages like this, analyzed it all, and said, they have judicious use of credit. Anybody have any idea what that means? Judicious use of credit.
Judicious.
Way too much.
Say what?
Like extreme like use of credit?
No. Let me tell you what it means. It means that you went to Home Depot instead of Sears, and you bought a washer and dryer on credit. And you took 24 months that they offered you, and you paid it off in the 24 months. And you, at some point, bought a car, and you financed it for whatever period of time it was, and you paid off the car, and that's it. You used credit to get you the things that you needed that were lasting a long time. So, you know, you're not going to buy a new wash machine every 2 years. And you're not going to buy a new car every 2 years. Or even if you paid it off, you know, you're not going to keep just rolling it every 5 years after you paid off the loan. You're using credit to help you finance the things that are important in your life. Can you use a revolving card and still have judicious use of credit? Yes, you can. What happens is, and now we can tell what you've paid on your card. Somebody could say, look, I've got a $10,000 credit line with MasterCard. And you charge $10,000, but you pay it off $10,000 a month also. That's judicious use of credit. You're using that revolving card because you can pay this thing off in the appropriate time, and you're not stretching this thing out and keep adding to it. What we're looking at, what creates a score issue is if you've got a credit line of $10,000 and you're over 50% of that credit line, and then you go out 3 months before you apply for a loan, buy a house, you got another credit line for $10,000 and you're at $5,000 on that one within 3 months, your score is going to drop, and that is not judicious use of credit. So what happened with FICO was eliminated the ability to explain why you had that $5,000 credit line on there. Maybe mother was sick and you had to pay $5,000 to the hospital to help her out, but it doesn't work like that anymore. You can't write that letter, document it. It's score driven because that's what Fannie Mae wants. And so then we get down to, you
Can you
pay your
explain
bills
what-
on time. Yes, somebody say something?
Can you explain what Fannie Mae means, or what is Fannie Mae?
Yes, thank you. Fannie Mae is a government-sponsored agency. What's commonly, the initials are GSE, government-sponsored enterprise, rather. And Fannie Mae is a buyer of mortgages. So when I write a loan and I bank that loan and I fund it and it says Sam Calvano on the note and the trust, that loan is sold to Fannie Mae. The money is then repaid to my credit line, and Fannie Mae holds the loan for investors. Right now, the federal government is one of the biggest holders of Fannie Mae mortgages. It's a secondary market. So I'm primary, Fannie Mae is secondary. So is Ginnie Mae and Freddie Mac. They each have different underwriting standards, and they're each secondary market, and they're each government-sponsored enterprises, GSEs. Does that answer it?
Yes, thanks.
Okay. So willingness to repay, we're going to stay on this for a little longer here. And the reason we're staying on it is because, once again, we get down to FICO. So you miss a payment on your credit card and your score drops 30 points. And it goes from 720 down to 690. And now all of a sudden you're in a different price range for your loan. So you don't want to miss your credit card payments. You don't want to miss any payments because it'll drive your score down so quick. In 1 month, I've had people say, oh, my score was like 750. It's like, oh, not anymore. You had a late payment to Citibank on your revolving card, and now your score is at 690. And I've seen it happen. Miss a car payment, it'll sink your score. Miss a house payment, it'll sink your score. I went and taught a class at a high school that I used to attend when I was in high school at Crawford High School over here in East San Diego. And I asked the students, I said, do you ever think that when you get out of school, you'll never have another report card? And I really didn't answer out of them because they didn't really know where the question was leading, but they knew it was going to be something that they couldn't answer. And I said, well, let me tell you something. I can tell more about you on a credit report than I could about your grades from your grades on your report card at school. Because we can tell so much, it's unbelievable. We know how you spend your money. We know how you use your money. We know how you use credit. We know what kind of a risk you're going to be by looking at that credit report. And they're going to ask questions. If you've asked for credit in the last 6 months rather, in the last 180 days, they're going to want an explanation. Did you get new credit? Did you use the credit? They want an explanation as to what you've done so that they can make a judgment about how to make your loan. Willingness to repay. So it's not just about scores. It's not just about making your payments on time. It's how you use credit also. Equity. I'm sure you've all heard the term skin in the game. Nod your heads. One way or the other. Yes? All you, Lynn.
Wait, could you repeat that? Heard the
Have you
term
heard the
what?
expression skin in the game?
Skin
Yes?
and gain?
Skin in the game.
No, I don't think I have.
Okay. Well, let me tell you what that means. That means you are putting up something of value. When it comes to housing, it's cash. So you want to come in and you say, look, I've only got 3.5% for a down payment on this house. You've got very little money in the deal. So on your $750,000 house, you are looking at $26,250. So let's say you don't make your payments and the house goes into default and the lender takes it back. That $26,250 was a big deal to you because you saved your money, you got it somehow and you put that money down. But when the lender takes that house back, that doesn't cover the cost of reselling the house. It doesn't cover the cost of the loss of interest. It doesn't cover the cost of anything until you get down to about 65% loan to value. So on a 750 house, 65% is $487.5 versus $563,000, right? Actually, no, that's not correct. Hang on. $723,000. The difference. So when you put more money down, we have less risk. And it's a proven fact that if you're buying a rental property, you'll let go of that rental property faster than you would the place where you put your head on the pillow at night. So in other words, getting back to the down payment, there's levels of risk. And all of these things that we're talking about here are different risks that we have to analyze when we're making a loan. So down to equity, you come into a transaction with 20% down on a $750,000 house, and you're looking at let's see, $150,000, right, as a down payment. You're not going to part with $150,000 too easily.
How'd you get that $150,000 number?
20% down.
Thanks.
Okay. So every time you raise the down payment, the cost of doing business goes down to you because our risk reduces. So if you're putting less than 20% down, we're going to have mortgage insurance. And if you go into default, the mortgage insurance pays the lender down to a certain point so they don't lose any money, or they lose less money on the transaction. But you as the borrower pay that premium every month. You came in and you said, okay, I'm going to borrow $500,000, and that was only 5% of the, or was 95% of the purchase price of the house, and you have good credit. It's going to cost you $604 a month on top of your principal and interest, taxes, and insurance for the mortgage insurance. And that's what you're paying to insure lender against you going into default. Does that make sense?
Yeah.
Okay. More money down, the lower the cost of the mortgage insurance. Now we get into different properties. So that's on a owner-occupied property. That's where you put your head on the pillow every night, and that's the end of it. Now, you want to buy a rental property. We're not going to let you in with 3.5% down. We're not going to let you in with 5% down. We're not going to let you in with 10% down. It's got to be 20% down to 30% down, depending on the property, so that there's a comfort level for the lender. Now you have a big stake in this. You're not, once again, if your rental property that you're buying is $750,000, you're not going to want to walk away from a $150,000 down payment. You're not going to want to walk away from, let's say it was an odd property, and you ended up having to put $225,000 down. You don't want to walk away from that kind of money. But if everything came crashing down, did in 2007, what would you get rid of? Anybody? The house you live in or the rental property?
Rental property.
Do you all agree? Probably the rental property would go first, right?
Yeah.
Okay. That's why they charge a higher interest rate for rental properties than they do for owner-occupied. More risk. More equity you have in the property, the happier we are as lenders, because you have more at stake than somebody with 3.5% down. Deal. It's all about risk. Have any of you ever applied for life insurance?
No.
No? No? Okay, I'm going to tell you something. All young now, this is the time to buy life insurance, believe it or not, because it's the cheapest you'll ever get it. When you're in your early 20s, it's the cheapest you'll ever get it. It's not that you want to load yourself up with life insurance, but to give you an idea of what I did, I bought one policy. I bought the option to buy other policies down the line, so that as I got older, I didn't have to go through any medical stuff. I just had the option to buy those policies, which eventually I did. But let me tell you what happens when you buy life insurance. First question they ask you is, do you smoke? Right? Everybody understands smoking causes problems. Do you drink alcohol? How many of you drink alcohol?
No.
None of you? Yeah, right.
Yeah, right.
Okay, yeah, you don't have to admit this. Okay. Your mothers don't want to see this.
Yeah, the whole thing's recorded, so.
Okay, don't answer that question. I'm just going to make the assumption. You've all had alcohol, all right? So the next question they ask is there heart trouble in your family, or have you ever had heart trouble? And have you ever had diabetes? And has anybody in your family had diabetes? And then have they had cancer? Blah, blah. And then they ask you, what are your favorite sports? And you say hang gliding. Well, guess what? Your risk factor just went through the roof, right? Because the chances of you dying hang gliding are pretty good. Much more so than other sports, right? I mean, how many people are eaten by a shark surfing around the world on a daily basis, right? But how many people have died on any given day doing hang gliding off some cliff. I mean, down here in La Jolla it happens, unfortunately, with some frequency. It's all about risk. When you start adding these levels of risk, yes, I smoke, I drink, I hang glide, I've had cancer in my family, I've had diabetes in my family, and I've had heart trouble. Well, your premium's going to go through the roof. All right? Okay. Take it back over here. Let's say you have very little equity. You have a low score. You have, let's just give them one here. We have job stability. And let's say that the collateral is okay. It's not fantastic, it's okay. So his interest rate's going up. Cost of mortgage insurance and his interest rate are here. Now they've gone to here. Willingness to repay, now this rate has gone up even further because these two items are too critical. Really, the risk factor just goes up exponentially. More so than starting a new job. More so than the collateral being in okay condition. All right. And that's what we're doing. So, y'all have a piece of paper in front of you and a pen?
Yes.
Yeah.
Everybody?
Yes.
Okay. All right. Here's what I want you to do. Put April 7th, 2020 on a piece of paper.
Can you say that again? Could you kind of cut out for a little bit?
Take a piece of paper and write April 20th, April 7th, 2020.
Okay.
Okay. I'm going to ask you a whole bunch of questions, and you're going to write the answers down on that piece of paper, and you're not telling me what they are. This isn't a test at all. Okay? And write the answers small because I want you to be able to take a piece of paper later on, and I don't want that whole 8.5 by 11 piece. Write it small in a corner. Okay? So, if you could live anywhere you wanted to, let's confine it to Southern California, all right? Because I've had people, when I've asked them this question, I want to live in Paris, I want to live in Tokyo. It's like, what the hell? Anywhere in Southern California, write down where you would live.
Beverly Hills.
I mean, when I was shopping for a house 25 years ago in San Diego, I started eliminating places, Point Loma, La Jolla, North County, and I finally settled on Del Cerro. It was a good spot for me to be. Think about where it is. Don't think too long. Question for you. All right. You want to buy a house or a condo in your favorite place to live? House or condo? Okay, next question. How many square feet do you want your place? 1,500, 2,500, 5,000? How many bedrooms do you want in your place? How many bathrooms do you want in your place? Right? And do you want a gourmet kitchen? Do you want a view? How many car garage do you want? Do you want a pool? Okay. Now, the reason I wanted you to write that is because I want you to tear or cut off that spot where you wrote it on, fold it in half. All doing it? Okay. Now, fold it in half again. And one more time. Keep folding. Get small enough to stick it in your wallet. Okay, very good. Show me. Hector, show me.
Got it.
Hey, John.
Got it.
All right, stick it in your wallet.
I gotta find that.
Here's what I want you to do. When you put that in your wallet, you're not going to look at it every day, but every now and then you're going to go, this piece of paper, and you're going to open it up. You're going to see all the stuff that you want to live. And believe it or not, you're going to end up there, because it's always going to be a reminder. You're not going to throw it out because it's not occupying too much space. It's just right in the back of your wallet, and every now and then you're going to see it. But what I want of you guys to do is to be pig and share with me your piece of paper, what you have on it. Who's going to do it?
I can do it.
Hector?
Johnny can do it. It's fine.
Hector, do it.
Okay. Wait, I have to unfold it. Give me a second. So you want me to tell
me
you
what
everything?
you got. Tell me where you want to live, the size of the house or condo, what good stuff.
Okay. Well, so I decided that I would like to live in Newport Beach or
Okay.
Irvine. I like OC. So, and I'd like a house for sure, because I can't think of living in a condo. That's not my thing. Square feet, I don't know. I put a question mark, but
Okay.
I definitely don't want it to be small. So,
Okay.
and I put bedrooms. I do want a lot of bedrooms. I put 5 to 7. So this is, I'm looking big. I'm dreaming big. Bathrooms, 2 to 4. I put probably 2 is too little for that big of a house. And then definitely huge kitchen because I like cooking. And then I want a beach view because I live in the desert and I don't want to stare at dirt anymore. And I don't know. I put 3-car garage, and for a pool for the pool, I definitely want a pool and a jacuzzi. I put jacuzzi too.
Okay. Good. All right. So 5 to 7 bedrooms in Irvine to Orange County. It's probably going to cost you about $1.3 million minimum, right?
Yeah.
Okay. So go along. This is how we qualify people. This says deal if it's written too small. This says in. This is debt. And this is qualifying. Okay, so we got a house for, let's just say $1,300,000. So who's got a calculator handy there?
Yep.
He's got it.
Okay. Is that Lamb?
Yeah.
That's gonna do this for me?
Yes.
Okay. Lamb, what's 75% of $1 million?
That would be 975,000.
Thank you. Okay, so that's our loan amount. Now,
That's a lot of that.
Hector's living in a house for $1.3 million. What kind of car do you think he's going to be driving? And how much is that car payment going to be? Is he going to be driving a S-Class AMG, or is he going to be driving a BMW Alpina, or is he going to be driving something, a regular Mercedes E-Class or a Cadillac, or what's he going to be driving?
Yeah, what am I going to be driving? I want to know what you guys think I'll drive.
Mercedes.
Mercedes.
Like a Honda.
Just a Honda Civic. I can see that.
Give me a car payment. $1,000 a month?
Oh my god.
Ooh, okay.
No, that's not gonna be 1,000 a month for sure. Maybe around like 2,500.
About
Mercedes.
how much, Lamb?
Good one. Will be 1,000.
Maybe like
2,500.
3,000 a month. Maybe 3,000 a month.
$3,000 a month?
For a
for his
Mercedes?
car? So he's gonna be driving a used Bentley. So Hector's got a wife, and she loves shopping down at that Newport Center. That's pretty pricey,
Okay.
and he gives her
Okay.
pretty much free reign on the credit cards.
Oh,
So, what do you think he owes in credit card debt?
10,000.
Earring.
Always
Isn't there a Gucci store there? I don't
Yeah.
know.
Well, that's gonna run you
No.
out some money real fast.
3 million. Oh God.
What's the name of that shopping center? In
Uh,
that high-end one?
The South Coast?
East Coast
South
Plaza.
There's a
South Coast
smaller
Plaza?
shopping center.
South Coast Plaza. Yeah.
Okay, so how much do you think he owes in credit cards?
Maybe a million.
Nothing.
$1 million? What?
Yeah, bro. We never know, man.
Let's say he owes $25,000. Okay.
That's
Wow.
$25,000.
All right.
That sounds reasonable.
So Lamb, take
Yes.
25,000 and multiply it times 1.875%.
1.75%.
Yeah, percent.
So
What's it come out to?
so that's gonna be 437.5 a month.
There you go.
Wait, 1.875?
1.87.
That would be 468.75.
So he's got $468 in revolve.
Yes.
Any student loans?
Zero.
I'm not at zero student loans. I'm like at
Oh, no.
9,000 right now in my
so
sophomore
let's,
year.
Let's just say that he's taking his time off the student loans and it's fun. And is this Hector's first or second wife? Is he paying child support and alimony or not?
It's his first wife.
His first wife.
Yeah,
All right.
yeah. The first and only.
You know that you cannot put it on your tax return anymore.
Okay. So he's got $37.68 a month in revolving in debt every month, right? Car payment,
Yes.
revolving, student loan, and we need a loan for $975,000. So let me give you an example.
Like 30 years, you think?
30 years.
Okay.
Okay. Are you calculating a payment?
Yeah.
Percent, Lamb.
So 5 divided by 12. Oh.
Okay, so I've got a payment, $975,000 at 4%. $4,655.
Wow.
Okay.
Okay.
Taxes on $1.3 million. No Mello-Roos, just regular old taxes. It'd be $1,400 a month. Insurance on that house is going to be $200 a month. Okay, so Lamb, what's the total here?
Yes.
4655, 1400, and 250.
46, 55, 1400
Correct.
and 400, right?
And 250.
250. That would be $6,305. $6,305.
Okay, so this number right here, this 6,305 for housing, when we're calculating debt ratios, this is called the front end ratio, housing, all right? Now, Lamb, add 6,305 and 3,768, please.
That would be $10,073.
$10,073? Okay,
Yeah.
so we're just gonna add these two together right here. Can you guys see this?
Yes.
And we come up with 10,073?
Yes.
Thank you. Okay. Take $10,073, which is total monthly obligations, and divide it by 44. What's my number,
Divide by 44.
please?
That would be $229.
No. That's not going to work. 1,073 divided by 45. It's 22,384. So here's what he needs to earn.
223? Oh, you divide by, oh, okay.
Okay, this is what Hector needs to earn in this scenario. What I did was I took the back end ratio, or the back end debts right here, divided it by 44%, and it comes out that he needs $22,384 a month. Gross income if he's on a paycheck, net income if he's self-employed.
Wow. I'm looking at my future right here.
You can do it, man.
I did this once to a class of 7th graders over at a middle school in National City. And surprised the letters they wrote me. This one gal wrote me this letter after the class was over. You know, I received all these letters about a week or two later. And she said, and I wasn't using these numbers at all, right? I mean, I was using stuff in San Diego that was really, you know, down to earth. And I asked him, I said, so how many kids do you want, you know? I gave him the whole thing like you guys, and in the letter, I was so depressed when you left. I don't want to have any kids.
Oh no.
Wow.
Actually, I have a question. Hello.
Okay.
So, can you talk about like the FHA loan qualifications? And I heard somebody tell me that they can convert their FHA loans to become conventional loans to reduce the fees, right?
The mortgage insurance.
The mortgage insurance, yeah.
Okay, so the first part of your question is what again? Tell me,
Yes.
ask me the first part of your question again, please.
Oh, so let's say I want to get qualified for FHA loans.
Mm-hmm.
Like what are the qualifications? Like what are the requirements for that? And after I got the loans, can I convert it into a conventional loans to reduce the mortgage insurance?
Okay. You cannot convert FHA loan. You have to refinance the property, put a new loan on it.
Refinance, yeah.
You can refinance it if there's enough equity, okay?
Yeah.
Because FHA is letting you in with 3.5% down.
Yes.
There are no conventional loans that will do a refinance high of a loan to value. You've got to have more equity in the property.
Yeah.
Then you can refinance and get rid of the MI.
Got it.
The advantage of using an FHA loan is very simple. They are more lenient. So here in our example where we used 44% as our debt ratio on the back end, FHA will go to 55.
Oh.
Gives
Wow.
you a little bit more room to maneuver if you've got higher debt. But you're paying mortgage insurance twice an FHA loan. You pay it up front. So let's say your amount was 100,000. The upfront premium that's added to the loan amount,
Oh, they add into the. Oh, okay.
$1,000. So now instead of a $400,000 loan amount, you've got a $407,000 loan amount. Okay.
Got it.
Then you're going to pay on that 407. $288 a month in additional mortgage insurance premiums.
Okay.
Okay. But here's the benefit though. It sounds like a lot and it sounds like it could be too expensive, but it's not. Because if you're getting into your first house and grandma and grandpa want to help you out with the down payment, they can kick in the entire down payment as a gift. Okay? Mom and dad, grandma, grandpa, aunt and uncle. No cousins, nothing like that. There's got to be a strong family tie there to be able to do this. Or the employer can do it.
Yes.
As we talked about earlier, you can have a higher debt ratio. All right? They'll allow the same interest rate, the variance in interest rate goes from 620 to 700. There's no difference if you were at 620 or you were at 699. 700 to 720 is a better rate. 721 and above is slightly better. So it's not as chopped up as a conventional loan. Okay?
Yes.
They'll allow more on refinance. They'll allow a higher debt ratio and a higher loan value on a refinance on an FHA loan. So they're more willing to forgive on certain things on the credit report, like a medical collection. In some cases they'll overlook it. The only problem with a medical collection on your credit report is it could be drawing score down to a lower level than what it should be. But even if your score is high enough, they won't require that you pay off the medical collection. But if you're buying on AT&T or Verizon, the cable company, or, water bill, that's drop your score, and that even on an FHA loan, that would have to be taken care of.
Got it. Oh, I see. So I need to have like a fees of like 7,000 add up into like my original loan amount, and then I will have to pay the fees on pay the interest based on my loans, based on my FICO score, and if there's are some kind of like expenses that we need to take care of before we get approved for the FHA loans, right?
Let me take you one step. Let's say you've bought a house, okay?
Yeah.
And you've written the offer, you're putting your 3.5% down, you're going FHA. If you are at that step, you're going to be paying some things up front. You're going to pay for an appraisal, you're going to pay for a home inspection. And those are going to cost you probably $1,000, give or take.
Oh,
And that's before we even get this thing into loan committee. Okay,
Yes.
so does that answer your question though? I don't know if I answered your question enough though. Was it?
It's
Go ahead.
okay. But I heard I heard my friend say actually a real estate agents, and she told me that there are like a loan amount, like there's a limit on how much I can borrow
Yes,
for FHA, right?
there is. Pricing is different within the limits. Okay, so if you're in Orange County, the maximum loan amount I think is $765,000 that FHA will guarantee.
264,000.
No, 765,000.
Oh, I see. That's pretty
Okay.
good.
So you came into this transaction at, say, with the average price of $750 in Orange County. You're going to come in with 3.5%, which is the $26,250. Okay.
Yeah. Yes.
You guys want to watch this? Because I carry on for a little longer if you want to.
What was the question?
Do you want to watch further what and the answer to Lem's question?
Sure.
Okay.
My income has to be. Wow, that's a lot. 64.
Okay. So
Yes.
let's take your 750 times 96. What's that
96
number?
times 96.
0.5. You're putting 3.5% down. We're going to make a loan of 96% of the property.
Oh, okay.
Come up with
720,000, right?
I came up with 723,750.
723.
Did you multiply it by 96 or 96.5?
96. Oh, 96.5.
Go back to
Got it.
96.5.
Okay. That would be 723,755.
Okay. Now, so here's our price. 750. Base loan amount. It's 723, 750. Now, add on to that 723, 750, 1.75%.
1.75%. All right.
What do you come up with?
So the 1.75% is 12,665. Add them up to the base loan amount. That would be 736,415.
Perfect. That's what I got too. Okay. So now we have our total amount. $736,415.
Yeah.
Okay. Can you calculate payments on your calculator? If you can't, don't worry about it. I'm just asking.
Oh no, I can't. My bad.
All right. So we'll do 30 years. Okay.
Okay.
4%. We've got a base loan amount of 736,415. So our payment is 3516.
3515. All right.
Okay.
Got it.
So let's say there's no Melrose tax on the property. It's just a straight property tax. So you're paying about $800 a month in tax and about $100 a month in insurance, house insurance, right? Fire insurance.
Yeah, definitely.
Okay. Now, let's take the total loan amount
Yeah.
and multiply it by 0.85%.
0.85%. That will be 625,953. 625,953.
Okay, hang on. Okay, we're gonna go with 6259. That's the pool for the year. And divide that by 12.
Oh, divided by 12.
Okay.
Okay.
What'd you come up with?
52,162, right?
Huh?
52,162.
521. Let's just go with 521. You're on. Okay. That's
Okay.
the mortgage insurance premium every month. So now we have 521. What's the total payment?
So 3515 plus 521 plus what's the
3516, 800, 100, 521,
800, 200, right?
100.
Oh,
800. This is
one.
yeah.
Okay. So 3515, 800, 100, and 521, right?
What do you come up with?
That would be 4,936.
Okay. Now, divide that by 45%.
Divided by 45. Okay. That would be 10,968.
Okay.
Oh, that's a lot.
So that's what you need to qualify for this. 10,968 just to
Oh, I
buy
see.
the house. Okay.
Got it.
That only leaves you about $1,000 a month for other debt here. So there's no $3,000 a month car payment in here. There's very
Got it.
little revolving debt. There's very little total debt, and there are no cosigns in here, right?
Yes.
We all agree with that? No signs?
Got it.
But you see how it all works?
I see. Thank you so much.
That's it. But let me give you one other thing.
Yes.
I'm going to give you a factor. Okay. Okay, here's a factor. Take $521 a month and divide it
Yes.
by 4.77.
4.73, right?
4.77.
77. Got it.
What'd you come up with?
That will be 10,922.
No, it's $109,000. You're close. It's just that you're reading it differently.
Yeah.
So this exercise, you guys, is this last little bit. That amount of mortgage insurance to $109,000 in borrowing ability.
Wow. That's crazy.
So if we go back to Hector's example, and let's say Hector says, look, I don't make $22,000 a month. How would we put that together for Hector? There's only one possible way. I'm going to give you an answer to the question here. There's only one possible way to put that together. Hector says, I really want this house right now. We're having kids. My wife wants this house. She's in love with it. I love my wife, and everybody knows happy wife, happy life.
Yeah.
I'm buying a house,
That,
Yeah.
right? You guys don't know that yet, but you Hector says, okay, I'm willing to give up the Bentley, the used Bentley for $3,000 a month. Step down to an E-Class, and I'll spend $1,000 a month. Lamp.
yes.
Divide 1,200,
1,200.
4.77.
0.477. All right.
What do you come up with?
That will be 25,157.
250,000, because Hector dropped his car payment from 3,000 to 1,000, and he can buy more house. And this is what we've had to do on occasion. We've just had to tell somebody, it's like, hey, what do you want more, house or car? I've had people sell their cars. It's just that simple. They want the house more than they want the car.
Oh my God.
For house.
Questions?
No.
Anybody
I
have
think
any
I'm
final
good.
questions?
Thank you so much.
You're welcome. So that'll wrap it up. There's always more, but this is a good overview of what we do here and what expected you're financing a house. So I hope
Got
it was
it.
some help.
That was really good information. Thank you so much.
Yeah, thank you so much for coming out. Well, not coming out, holding this virtual presentation. I hope that
Yeah.
next year you can actually come out. I would love to have you at UCI. Yeah, I really enjoyed this presentation. Gave me a lot of motivation so I can get a nice beach house in the future. Yeah.
Let me
Oh
tell you
my
something.
God.
I'm going to tell you a little story to wrap up.
Okay.
I was selling real estate, like I told you, from 1976 to 1981. And I sold my broker the house that he eventually, this house that he's staying in. And it was a brand new house in Del Cerro on the main drag. And one day I went to visit him, and I did something that really, truly angered me. And as I was driving further up the street, and then I turned around, I came back down for some time. I was so angry about it. It was occupying my mind for about a half an hour. And I thought to myself, you know what? Someday I'm going to live in a house further up the hill than him.
Mm-hmm.
And I saw this house. That was in 1970, like 1979, 1980. And one day after I bought the house that I'm living in, I was standing up in the house. I looked around. This is the house. That was the house that I saw the day that I told myself I was going to buy that house and live further up the hill than him. That's why I want you to put that piece of paper in your wallet. Whether you buy that particular house is irrelevant. It's just that you've now set yourself on a train of thought that's going to not control your life, but it's going to give some focus to where you are financially. It works, believe me. When I started selling loans in 1983, I was Pontiac Sunbird. I hated the car, totally hated it. Stick shift, had air conditioning, radio played, power steering and power brakes, that was it. But I hated the car. So I went down to the Cadillac dealer and I got the gal business card, and I stood in front of the speedometer. So every time I looked at the speedometer, I looked at the Cadillac emblem on her car. And it's like, okay, I'm due for a Cadillac. And it happens. This will happen to you, I guarantee you. It might not happen quickly. It'll happen. And I hope it does. Thank you.
Thank you.
Thank you.
Yeah.
Thank you so much, Sam. It was good. Very good.
Yeah, thank you. Thank you so much. I really appreciate it.
My pleasure. John, we'll connect mañana, eh?
Yes.
Okay. Good night, you guys.
All right.
Have a great night.
You
You too.
have a great night.
Bye, everyone. Bye. It was
Everyone.
nice to meet you.
Bye.